Credit score myths are costing millions of people money. How well can you spot fact from fiction about your own credit score? Here's how it works. 10 questions, multiple choice, 5 seconds each, 1 point apiece, keep track. Your score at the end reveals your credit myth-busting ability. Question 1. The classic credit score scale. How high can it actually go? It's B, 850. The scale runs from 300 to 850, and almost nobody needs a perfect score. Hit around 740 and you already unlock the best rates lenders offer. The last few points are just bragging rights. Question 2. Which of these matters most for your credit score? Your income, whether you pay your bills on time, or how many credit cards you own. It's B, paying on time. Payment history is the single biggest piece, worth about 35% of your score. And notice what's not on the list? Your income isn't part of your credit score at all, a fact that surprises almost everyone. Question 3. Does checking your own credit score lower it? The answer is B. No, never. Checking your own score is what's called a soft inquiry, and it has zero effect. The myth that looking hurts keeps millions of people in the dark about their own credit, so check it as often as you like. Question 4. To protect your score, how much of your credit limit should you actually be using? The answer is A, under 30% and ideally under 10. This is called your utilization, and it's about 30% of your score. Even if you pay in full every month, a high balance reported on your statement can still ding you. Question 5. You've got an old credit card you never use. What happens if you close it? It's B. Closing it usually hurts. You erase that card's available credit, which spikes your utilization, and over time, it shortens your average account age. The counterintuitive move is to keep the old card open and use it once in a while. Question 6. Does carrying a balance from month to month actually help your credit score? It's B, no. This is the most expensive myth in personal finance. Your score is built from on-time payments and low balances, not from carrying debt. Paying in full every month builds credit and costs you nothing in interest. Question 7. When a lender runs a hard inquiry to approve you, how much does it typically hurt your score? The answer is A, usually just a few points, and it fades within a year. Even better, when you rate shop for a mortgage or car loan in a short window, all those inquiries get bundled as one, so comparison shopping won't wreck your score. Question 8. Which of these is actually part of your credit score? It's A, your credit mix, meaning a blend of cards and loans worth about 10%. Your bank balance, your salary, and your job title, none of them are in the formula at all, even though almost everyone assumes they are. Question 9. The one most people get wrong. What's the fastest way to boost your score in a single month? It's B. Pay your balance down before the statement closes. Utilization updates fast, so lowering the balance that gets reported can move your score within one cycle. The trap, the 2 responsible sounding answers, opening cards or closing them, actually backfire. Fight about it in the comments. Last question. There's a legit trick called becoming an authorized user. What does it actually do? It's A. When you're added as an authorized user on an established card with on-time payments, the history can report on your own file. It's how parents jumpstart a kid's credit. The debatable part, some newer scoring models count it less, so it's powerful but not guaranteed. Pens down, add up your score. 9 or 10, you're a credit genius, genuinely in the top few percent. 6 to 8, above average, better than most adults. 3 to 5, you're getting there. But there are gaps quietly costing you money. Below 3, you're exactly who these credit myths were built to confuse. But you just learned more in a few minutes than most people learn in a decade. Drop your score in the comments and tell me which one got you. And if you want to protect the money you're building, the Spot the Scam quiz is next.